Welcome to this series on the Pandemic Risk Insurance Act of 2020, where we will take a constructive but critical look at H.R. 7011 and other proposals to establish a pandemic insurance program. This is your host, Jason Shoup, founder and managing member of the Centers for Better Insurance. Episode 2, the Diversification Penalty. In Episode 1, we discussed how the Pandemic Risk Insurance Act, or PRIA, would leverage the federal backstop framework developed for the Terrorism Risk Insurance Act, or TRIA. Let's quickly review the main components of the backstop under TRIA and PRIA. Each insurer must retain a certain amount of insured losses, known as the insurer deductible. Once the insurer has satisfied this deductible, the backstop reimburses the insurer for additional losses. This reimbursement is known as the federal share. The unreimbursed portion above the deductible is the insurer co-share. This episode focuses on how the design of the insurer deductible undermines sound risk management principles. The insurer deductible is based on a percentage of the insurer's, or group of affiliated insurers, prior year direct earned premium for specified lines of insurance. For TRIA, the insurer deductible is 20% of direct earned premium. For PRIA, the insurer deductible is 5%. Let's dig into the lines of insurance that are relevant to calculating the deductible under TRIA and PRIA. The backstop deductible for both TRIA and PRIA is based on direct earned premium for commercial property and casualty insurance, subject to certain exclusions. The easiest way to figure out an insurer's deductible is to consult the annual statement. The insurer reports its direct earned premium for each of the 33 defined lines of business on what is known as statutory page 14 in that filing. For our purposes, we can group the lines of business used to calculate the insurer deductible into 3 buckets. Property insurance, which consists of fire, allied lines, inland marine, and boiler and machinery. Casualty insurance, which consists of workers' compensation, other liability, including excess workers' compensation, and products liability. Multi-peril insurance, which consists of commercial multi-peril, ocean marine, and aircraft. Premium associated with the following insurance is excluded from the calculation of the insurer deductible, even if it has been reported in one of the previously mentioned lines. Personal lines insurance, commercial automobile insurance, and professional liability insurance, including for medical malpractice. The premium driving up an insurance company's backstop deductible is not necessarily the same premium causing it exposure to losses from acts of terrorism or pandemic. Let's compare the lines of business driving up insurer deductibles with the lines of business that sustained terrorism losses from September 11. Commercial liability makes up about 37% of insurer deductibles, but represented only 13% of September 11 losses. Similarly, workers' compensation drives about 26% of insurer deductibles, but only 6% of September 11 losses. On the other side, commercial property premium contributes only 36% to insurer deductibles, but 69% of September 11 losses. The aircraft line of business is even more pronounced. Premium for aircraft coverages makes up a mere 0.5% of insurers' backstops, but drove 25 times that proportion of September 11 loss totals. What does this tell us? There is little correlation between the amount of an insurer's TRIA deductible and the amount of the terrorism risk in the insurer's portfolio. The disconnect between insurer deductible and risk is even more pronounced under the proposed Pandemic Risk Insurance Act. The insurer's PRIA deductible is calculated based on the same lines of business as TRIA: commercial liability, workers' compensation, and commercial property. However, an insurer can claim reimbursement from the PRIA backstop only for business interruption and event cancellation losses. These coverages are components of commercial property insurance. Let's see how this disconnect plays out by looking at three very different insurance companies. The Hartford is a national P&C insurer with a diversified portfolio, roughly in line with the overall market. FM Global is a commercial property specialist. State Farm is the market's behemoth, but with a surprisingly small footprint in commercial insurance. About 60% of Hartford's overall premium contributes to its insurer backstop. 90% of the premium written by FM Global, the commercial property specialist, drives its insurer deductible. Only about 5% of State Farm's overall premium is used to calculate its backstop deductible. Recall that PRIA only applies to commercial property insurance, specifically business interruption and event cancellation. Hartford has a slightly smaller commercial property portfolio compared to State Farm, while FM Global's is nearly double the size. You would not know it by looking at their respective backstop deductibles. Hartford, with the smallest commercial property portfolio, has the largest insurer deductible, almost 3 times the size of FM Global's, even though FM Global's portfolio is close to twice the size as Hartford's. State Farm has a portfolio larger, but closer in size to Hartford's. Yet, its deductible is only half the size. So, what have we learned about TRIA and PRIA? First, the structure of the backstop penalizes insurers that build diversified commercial P&C portfolios. Second, the backstop rewards insurers who concentrate risk. Basic principles of catastrophe risk management tell us to diversify risks, not concentrate them. While the diversification penalty exists under TRIA, the narrow scope of insured losses covered by PRIA promises to amplify this disconnect for the pandemic risk. In the next episode, we will explore how hundreds of large corporations have opened up their own insurance companies to take advantage of this anomaly under TRIA and could easily retool their financial engineering to tap into PRIA. We will continue to look at the elements of PRIA and other proposals for pandemic risk insurance programs in subsequent episodes. In the meantime, you can learn more about the Pandemic Risk Insurance Act and the Terrorism Risk Insurance Act at betterins.org. On behalf of the Centers for Better Insurance, thank you for taking this time.